Have you ever wondered why the absolute peak of American wealth isn't actually built on a salary? I mean, no matter how astronomically high that salary might be, it's almost never the real engine behind the top 1%. Welcome to This Explainer. Today, we're cutting straight through the headlines and taking a cinematic dive deep into the actual structural mechanics of American wealth creation. We're going straight to the source, using official data from the Federal Reserve, the Census Bureau, and the CBO to uncover exactly why the wealthiest individuals own businesses instead of relying on wages. Our goal here is pretty simple. We're going to objectively explore the financial, historical, and tax-based anatomy of wealth. So let's get into it.
Think about this number for a second. 14.5%. Right now, the top 0.1% of households in the United States own 14.5% of all U.S. household wealth. Just let that sink in. That is nearly 6 times the share owned by the entire bottom 50% combined. And it really begs a provocative question. Exactly how did they get there? Are they just incredibly good at saving their paychecks? Or is there a fundamentally different engine driving their net worth?
The sheer scale of this divide is just staggering. When we pull the Q1 2026 Federal Reserve data, we see the top 0.1% holding over $25 trillion in assets. That's a massive 13% share of total assets. Meanwhile, the bottom 50% holds just over $10 trillion. But you know, the real story here isn't just the total dollar amount, it's the composition. The fundamental difference between these two groups isn't just how much money they have, it's what they actually own.
Part 1. Labor versus capital.
Okay, so historically, between 1948 and 1979, the U.S. operated on what economists call a shared growth model. Productivity skyrocketed by 97%, and the typical workers' compensation marched right alongside it, rising by 91%. Everyone was winning. But after 1979, the timeline completely fractures. We enter this era known as the productivity pay gap. The economy basically shifted away from shared prosperity. Workers kept getting faster, smarter, and more efficient, but their real wages essentially hit a brick wall, all while overall productivity just kept on climbing.
So here is the absolutely crucial point. When you get more efficient at your job, but your paycheck stays completely flat, where does that extra value actually go? Well, the owner captures that surplus value. Since 1979, this lack of equity ownership has meant that nearly half of the total income gains in the entire economy were effectively locked away from 90% of workers. It's really simple. Without ownership, you just cannot capture the financial upside of increased efficiency.
And this historical shift, it builds directly into our modern portfolios. It completely dictates how wealth is stored today. For the middle class, wealth relies heavily on real estate, specifically highly leveraged primary residences, which is a great foundation, sure, but it doesn't exactly print cash. Now, flip over to the top tier of the wealth distribution. They hold the vast majority of their wealth in private business equity and stocks. They own scalable, high-yielding assets. To put it simply, they own the engines of the economy, not just the shelter.
Part 2. The tax shield advantage.
First up in the tax code playbook is QBI, or Qualified Business Income. This is a deduction designed specifically for pass-through business owners. We're talking sole proprietorships, LLCs, S-corps. Because look, if there's one thing the tax code loves more than being incredibly complicated, it is rewarding those who take on the massive risk of business ownership. QBI reduces your taxable income right off the top, entirely bypassing the standard corporate tax structure. It's this incredibly powerful, fully legal shield that your standard W-2 wage earner literally cannot access.
And the scale of this shield is massive. 20%. Eligible pass-through business owners can deduct up to 20% of their qualified business income before it's even touched by taxes. If you're a business owner managing your W-2 wages and qualified property the right way, this deduction acts as an absolute booster rocket to your ongoing operational cash flow. It leaves you with so much more capital to reinvest and compound your wealth faster.
Now, while QBI is amazing for your ongoing day-to-day cash flow, Section 12002, better known as QSBS, or Qualified Small Business Stock, is basically the holy grail of exit strategies for successful founders. This is the ultimate capital gains shield. It allows eligible non-corporate taxpayers to exclude massive, and I mean massive portions of their federal capital gains when it comes time to sell their qualifying small business stock.
Exactly how massive are we talking? 100%. Yes, for shares acquired and held for over 5 years, this shield can mean up to 100% tax-free federal capital gains. It effectively drops the federal tax rate on the sale of a business to 0. Just imagine grinding, building a company for a decade, and then selling it without paying federal capital gains tax on the lion's share of the payout. No way around it. That is a structural advantage that transforms someone from merely being rich into generating true generational wealth.
And the crazy thing is, the landscape for this just got even more favorable. Recent enhancements from the One Big Beautiful Bill Act, OBBA, signed in July 2025, actually expanded these benefits. For stock issued after July 4th, 2025, the corporate asset cap to even qualify was bumped up to $75 million. The individual exclusion limit jumped to $15 million, or 10 times the cost basis. So with proper planning, you can hit even higher caps. Plus, they introduced partial benefits starting at just 3 years. The tax code isn't just permitting this, it's actively incentivizing and rewarding this exact type of equity creation.
Part 3. The power of compounding. When we map the long-term journey of high-quality equity compounders using data from Morgan Stanley, a truly fascinating pattern emerges. Just look at the sheer resilience. Even during massive run-ups to economic crises and the scary market drops that follow, high-quality businesses, the ones with recurring revenues, high gross margins, and low capital intensity, they manage to recover. They just keep compounding wealth. Contrast that dynamic, uncapped growth potential, with the flat, nominal cash flows you get from, say, a sovereign bond or a fixed salary. It's night and day.
And this is especially critical in today's environment. Compounders act as incredible inflation hedges because they possess exceptional pricing power. Think about it. In a high-debt, higher interest rate environment, a business that can seamlessly raise its prices to match inflation is going to protect your wealth far better than a stagnant wage ever could. If you rely solely on a salary when inflation hits, your purchasing power just drops. But if you own the business, you just adjust the prices.
Part 4. The price of admission, risks and reality.
Now, to bring total balance to this explainer, we have to acknowledge a pretty stark reality: 40%. Research actually shows that the typical future small business owner already has 40% more liquid wealth than a typical wage earner, long before they ever start their firm. It's a harsh truth. Entrepreneurship requires capital. You need it to mitigate your risk and fund those early operations. So, the engine of wealth creation we've been talking about inherently favors those who already have a financial cushion.
This liquid wealth threshold literally makes or breaks you early on. A founder in the bottom quartile of wealth typically starts a business with an average daily bank balance of just $1,000. A top quartile founder, they're starting with $24,000. The data is crystal clear here. Businesses founded with higher liquid wealth are structurally much more likely to survive, access better financing, and eventually generate that long-term wealth. If you start with too little, your odds of surviving long enough to actually see that compounding effect are drastically reduced.
And naturally, this huge barrier to entry directly impacts who gets to participate in this whole wealth creation model. When we look at demographic data from 2022 to 2026, business ownership remains highly concentrated. It's 73% white, 8% black, and 7% Hispanic. So while entrepreneurship is absolutely proven to drive upward wealth mobility across all groups, the required starting capital to even get in the game is simply not evenly distributed across the population.
So, what is the ultimate takeaway from all this? The mechanics of the system are undeniable. From capturing surplus labor value, to utilizing QBI and QSBS tax shields, to leveraging the incredible pricing power of compounding, business ownership really is the structural supremacy of American wealth accumulation. But as this concluding quote highlights, the real question is access. Will the upcoming great ownership transfer expand this powerful, equity-based model to a broader segment of the population, or will it remain an exclusive engine locked away for the top 1%? It's a massive dynamic that is undoubtedly going to shape the future of our economy. Thank you so much for joining me on this explainer. Keep questioning the mechanics behind the numbers, and I will see you next time.